In this video, we're going to take a look at the guidance that management provided on last quarter's Fitbit call, and that is available on the Investor Relations homepage. You can see we've highlighted some of the key items down here. And we're going to compare that guidance using our earnings model to the consensus estimates heading into this quarter's release. So if you'd like to download our model and follow along or plug in your own assumptions, you can download this model for free on our webpage, gutenbergresearch.com. Click on the Models tab, scroll down to Fitbit, and click the icon to download. Last quarter, there were a bunch of really important points that management went through that we had to incorporate into our earnings model. Before we go through the model, we just want to quickly remind you of those points. So first, we had the launch of the Alta and the Blaze this quarter, and management did say that while some of the sales would come through in the first quarter, the majority of the reorders wouldn't take place until the second quarter. So in the model, you'll see a dip in revenue in the first quarter and then a recovery in the back half of the year. Then if you move down to gross margin, management gave pretty weak guidance on the gross margin front for the first quarter of this year, and that was really to reflect the additional costs associated with manufacturing of the new products. And then if you move down to OPEX, management gave very weak guidance on total EBITDA margin, which includes the three operating expense items: sales and marketing, general and administrative, and R&D. For the sales and marketing, the sales cost as a percentage of revenue in the fourth quarter of last year was actually very high, and that was a result of the launch of new holiday ad campaigns in several markets, as well as the Super Bowl ad campaign in the fourth quarter. And then management guided the sales as a percentage of revenue for the first quarter to be consistent with the ratio that we saw in the fourth quarter. So that was pretty weak. That's going to be a very high sales expense for this quarter. And then, as one analyst pointed out on the call, even when you have that high sales expense to revenue ratio for the first quarter, you still can't get back to management's EBITDA guidance. And they said that the majority of the difference would then be associated with higher general and administrative costs and higher R&D. So we've incorporated those items into the model, which we'll go through now. And then just one other key thing that'll probably come up on the call this quarter is the deal with Alibaba and how it's going to relate to their overall strategy of growth in China and what kind of impact that might have. So hopefully there'll be a bit of a bump in the guidance for the full year 2016 related to their expectations for China. So you can see we've highlighted the main points of guidance that management gave on the last quarter earnings call. And we've actually incorporated these into our earnings model as comments. So rather than toggle back and forth, we're just going to rely on the comments that we have inserted here. So for example, the first quarter revenue is expected to be in the range of 420 to 440 million. And if you just quickly go back to the press release and scroll down to the first quarter, you can see this is exactly where we took that item from. So if you want to check any of these, of course, you can download the press release and take a look. So let's start with the revenue line, and you can see that we've calibrated this model to be in line with consensus estimates for the next 4 quarters. And when you sum those 4 individual quarters and take a look at this guidance for management for the full year of 2016 between $2.4 and $2.5 billion, the consensus is in fact in line with the revenue estimate. And if you look at management's guidance for the first quarter, the street is just above the high end of the range for management's guidance. And then if you scroll down to the segment details, we can see how we actually built up our model to get to that revenue. So for Fitbit, this is a very straightforward model. We take growth rate and apply it to the total units sold, and then we multiply that by an average selling price per unit. So you can see in the fourth quarter of last year, the average selling price per unit was $86.78, and this quarter we're estimating $85. And when you think about this average selling price, it's not exactly what you would expect. So you might look at this and say, well, you know, I know that a lot of the devices retail for $199, so this seems very low. But this is actually the revenue that's recognized in US dollars per unit. So it's just taking the total number of shipments that they had in the quarter and dividing the revenue by this number. So it's not exactly an average selling price per unit. So in terms of the growth rate, you can see this large decline quarter over quarter from the fourth quarter of last year. And if you look at how the March quarter typically looks, there always is a sharp decline between the December quarter and the March quarter. And that's just to reflect the increase in sales for the holiday shopping season. And then that's followed by a decrease in sales. But this time it's a little bit deeper of a decline than what we saw last year. And the reason is that they're really shifting their models. So the Blaze and Alta are going to ramp this quarter, but we think just based on the timing of when those sales will be recognized, the total shipments will look a little bit weaker than what would be expected just based on typical seasonality. And this is actually an area where you can download the model and put in your own assumptions. So if you look at what the average selling price per unit was over the last couple of quarters, you can see in June it was almost $90, in September it was $86, and in December it was about $87. So you might say, oh, their estimate for average selling price is a little bit too low, and you can just plug in whatever you want here. So if you want to go up to $90, and then it'll translate through the rest of the income statement. So I'm going to undo that for now, but definitely feel free to put in your own assumptions there. So that takes care of the revenue line. Then we're going to move down to gross profit. So we weren't really creative with the gross profit estimate. We just got back to the non-GAAP gross margin that management gave us guidance for at 46.5%. And that's how we got back to this total gross profit line here. Oh, excuse me, non-GAAP basis. So here. Then management gave so management didn't officially give guidance for sales and marketing expenses, but in the Q&A section of the earnings call, they did say that as a percentage of total revenue, it would be consistent with the fourth quarter. So that was that one piece of information that we were talking about in our opening statements. And you can see that the difference between the sales expense in the September quarter, about 16% of total revenue, to December was huge. So this was a very big quarter, the last December quarter, for sales and marketing expenses for Fitbit. And to have that repeated in the first quarter of this year is just kind of crazy. But the launch of 2 new products and their global expansion is likely the reason for it. And then they did say that the sales and marketing as a percentage of revenue would stabilize through the rest of the year. So you can see we've kind of incorporated that reduction. But overall, it's still much higher than what we saw last year. Now for R&D and general and administrative expenses, the other 2 OPEX items, management didn't give specific details on what those estimates would be for this quarter on the earnings call. But in the Q&A section, they did say that there would be an increase in the first quarter as a percentage of total revenue, and that's how we would get back to their EBITDA guidance. So we're going to scroll down to their EBITDA details. And before we get down to EBITDA, we should stop at stock-based compensation, because management does give, that's the primary non-GAAP adjustment, and management does give guidance for that item. So you can see that we have just set our model to meet the guidance. So for the first quarter of this year, stock-based comp is expected to be in the range of 18 to 20 million. So we have 19 million. And then for the full year, it's expected to be in the range of 85 to 95. So we hit that 90 million target. So down here is our adjusted EBITDA calculation, and you can see stock-based compensation hits this row right here. And then it's just adding back all the non-GAAP adjustments and depreciation and amortization and income tax expense and interest expense to get back to adjusted EBITDA. So they guided adjusted EBITDA between 5 and 16 million, and you can see we're at the high end of that range at this point. And that's really to get back to the total EPS estimate. But in order to get to this range, because you can see that this is a much, much lower EBITDA margin than what we've seen in the past. So in order to get down to this very low EBITDA margin, we had to really increase the the R&D and G&A expenses as a percentage of revenue. So we went from about 8.5% of revenue for R&D to 14.6% for the first quarter, and about 4% G&A to 10% in the first quarter. And a lot of that has to do with the fact that the revenue base for the first quarter is so low because they're launching the new products, and there's also a lot of costs associated with that. So this is really going to be an abnormal quarter, this first quarter. But we were in fact able to get back to the high end of management's EBITDA range, using those estimates. And we were in fact able to get back to the diluted EPS per share of this is really like 2.6 cents per share. So it's really at the high end of management's range of 0 cents to 2 cents. But overall, we would say that the street is at the very high end of management's range heading into this release. So next, let's take a look at the valuation. This is a tier 2 model, so we're only using a multiple base valuation approach, and we separate the value of net cash per share from the value of the equity, and we calculate a next 12-month price earnings ratio based on the consensus EPS for the next 12 months. And if you look at where shares are trading at right now, they're trading at about 13 times the next 12-month consensus estimate, which is really about the high end of the range over the last 3 months. I think that, coupled with the fact that the street is already at the high end of management's guidance range, it sets up a situation for a little bit of risk, but there are just so many catalysts with this company right now. If the launch of Alta and Blaze was very strong this quarter, that could have a huge impact on management's guidance for the rest of the year. And in addition, the deal with Alibaba could be a huge catalyst if it's going to translate to significant growth in China. So there's just so many upsides. It's pretty clear why the market has priced shares this high heading into the release. And there'll just be a number of things to watch for. So make sure you join us after the release. We'll update this model for the new details for the March quarter and the additional guidance that management gives for the full year 2016. And if you're interested in financial modeling, please be sure to subscribe to our YouTube channel. Thanks for watching, and good luck with the rest of earnings season.